Hey there, everybody. Thanks so much for joining us for our live Thursday webinar here at RealWealth. I'm Leah Collich, an investment counselor at RealWealth Network, and normally you get to see my face on these, but unfortunately GoToWebinar is having some technical glitches today, and there is no option for me to turn on my camera, so you'll just have to envision my face. You see me right there. But I promise I'm here live talking to you guys and excited to bring you what is one of my favorite classes. I think this is such a fundamental paradigm when it comes to investing in real estate, understanding the 5 ways that you make money when you own, buy, and hold rental properties. So I'm really thrilled to bring you guys this presentation today, whether you're new, whether you've been investing for quite some time. It's always beneficial to bring it back to the basics, really get a solid understanding of why it is that we think this is the best asset type of choice. So thanks again for joining us today. We'll get right into it. First, I've got a little disclaimer for us. So the strategies we're going to talk about in our presentation today might not be appropriate for everyone. There are lots of ways to invest, lots of ways to make money. We're not going to talk about all of them, so just know there are other options out there that might be more suitable for you and your specific circumstances. So be sure that you're consulting with your own squad, your own personal accountant, tax advisor, and/or attorneys to understand how these strategies might impact you differently than others to determine whether it's the best strategy for you. Past performance is no guarantee of future results. Real estate purchases are subject to investment risks, including the possibility of losing the total amount of money that you have invested. So while I have made every effort to bring you accurate and current information today, you should know that I'm not perfect. The possibility of errors and/or updates always exists. I want to remind you guys, we are recording this webinar. We'll get it posted to our YouTube channel and to our investor portal by tomorrow afternoon, so you can always come and watch the replay. We are going to open it up for a few minutes for Q&A at the end. So if you have any questions or if this sparks any curiosity that you want to discuss in real time, feel free to pop open that question control panel and send in your thoughts. All right, so if you are new to RealWealth Network, I want to give you a little bit of introduction so you kind of understand where I'm coming from. As I mentioned, I am an investment counselor here at RealWealth Network, but I'm also a real estate investor. I was a real estate investor before I became an investment counselor here. And I want to share with you a little bit about how that came to be. I am married to an active duty Army officer, and that has given us the wonderful gift of moving a lot. And we've spent most of our adult lives living overseas. We got to live in Asia, Europe, and South America. We've lived on the East Coast, the West Coast, and now we're currently in San Antonio, Texas, as of this summer. So, and I really owe a lot of our interest and our passion in real estate investing to my husband's military career. It just opened our eyes up to one, just a comfort level with different places and owning property in a different area and researching a different state. But also it was really driven by our sudden realization that we were doing everything quote unquote right in planning for retirement. My husband's working for an employer that offers a pension. We're stocking away money in retirement accounts, maxing out 401ks and IRAs, trying to be well diversified in mutual funds, doing everything right. But then at some point we realized, oh, wait a second. We are putting all of our money, the majority of our money in our retirement planning, into accounts that have prescribed timelines and also have limits to how much we can actually put in those accounts. And so we started looking at what we were doing with our finances and looked at a little rental property of ours that we had kept in a previous assignment in Southern Alabama, actually. And we had kept it as a rental all that time, and it was cash flowing. And we realized, man, that was a great investment for us, and it kicks off a really great dividend, and someone else is paying off the loan for us. We should probably get more intentional and replicate that strategy. And so after we had flipped a house and freed up a bunch of capital, we decided we were going to go full tilt into real estate and spread that cash out into as many rental properties as we could. And we were actually doing this from Europe. So I say this to share with you, this is how I came to find RealWealth Network. We were wanting to leverage the time and experience and relationships of people who had done this before in markets that maybe I was prior unfamiliar with. And so RealWealth Network helped us scale remotely from across the world. We scaled our portfolio pretty quickly and just really discovered a passion and interest in this that fueled us like nothing had before. And so we've been investing now for about 10 years, and we're diversified in a couple different states. I invest in Texas and Florida for appreciation, and Ohio and Alabama for cash flow. Love it. I do acknowledge there are so many different ways to make money in real estate. That's part of the reason why I love it so much, is there is no one size fits all approach. I love flipping. I think there's really great return sometimes on a active investing strategy and fast cash, but I really personally believe that long-term buy and hold real estate is how you create the most meaningful and powerful wealth. So I'm thrilled today to share with you some of those fundamentals that just got me addicted to this investing strategy, and hopefully I pass along some of this interest that I've acquired. So as an introduction, I touched on this real briefly. You know, real estate has built wealth more consistently than any other asset class out there. Home ownership is cultural. I think it's uniquely American. We still have some of the highest home ownership rates in the world. And if you look at where the vast majority of Americans have their wealth, it's oftentimes in their primary residence, in their real estate holding. So it's such a powerful tool. And I really think the fact that real estate is such a cultural thing for us, it's part of the American dream. It's a blessing and a curse when it comes to real estate investing, because we tend to be a little bit emotional about home ownership. And so kind of switching our perspective and viewing home ownership as a tool can be challenging for some. But again, through today's conversation, I'm going to help you kind of look at home ownership through a different lens and see how it really can help you just boost your wealth creation. Our mission here at RealWealth is to raise the wealth consciousness so that people can create more freedom through the ownership of property. A lot of people, I think, get into real estate investing because, frankly, there's a lot of gurus out there pushing cash flow, right? And cash flow is so important because cash flow is what ultimately can free us from a 9-to-5, from a W-2 job, right? We can have flexibility if we can create our own stream of income. But too many times I see people get so hyper focused on that cash flow, and they're not realizing that, hey, there's actually more to it than just cash flow. And it doesn't mean that we have to be ready to quit our jobs a year from now to get into this strategy. So I'm going to give you guys a really holistic kind of overview today on the 5 different ways that real estate pays you. So these are the different areas we're going to focus on. We're going to go each item at a time. We're going to start with cash flow, move into principal pay down. We're going to discuss some of the tax benefits. We're going to talk about how real estate is an excellent hedge against inflation. Inflation is, I think, a hot button word here lately, as we are maybe arguably entering an inflationary time in our world. Everybody is looking for how they can hedge themselves against this inflation. And we think real estate, owning assets, hard assets, is one of the best ways to do that. And then, of course, the cherry on top, or the roof on top of our little house here, is the appreciation. So many times, again, people are hyper focused on cash flow and appreciation, but there's 3 other ways that we make money when we own real estate. So let's talk about it. Number 1, cash flow. So cash flow is the money that comes to you after you have paid all of the expenses of owning the property, and in our case, including property management. We own property out of state, and RealWealth has teams all in about 12 different markets across the country. So we always include having a professional property manager in our operating cost of that property. So just for demonstration's sake, let's use this very, very simplified example. If you can purchase this property here for $100,000. To determine how much cash flow that property will give you as an investment, you want to take the income of that property, the rental value of the property, subtract all of your expenses, and what's left over is your cash flow, your net income. I pulled a recent pro forma for you guys. This is actually a real listing from one of our RealWealth property teams. We had them on for a webinar just about 2 weeks ago. So this is a very recent example, but I wanted to show you guys an example of our property pro formas. So these pro formas are just straight projections. When a property team or when a seller is selling a property, they'll oftentimes offer you this pro forma so that you can see what those projected monthly expenses are going to be, and then line them up with that rental income so you can see what your net or your positive cash flow will be. So let's take a second to study this together. The first column you see here is if you are a leveraged buyer. So this is if you plan to purchase a property with only a 20% down payment, so you've got an 80% loan to value ratio. And for this example, we're assuming a 4% interest rate. Okay, so the purchase price for this house is $200,000. Down payment of 20% is $40,000. You're going to have closing costs. This is just an estimate. It will vary depending on the lender and the loan that you are using, giving you an initial cash investment of $44,000. So the next section here breaks out the reoccurring monthly costs. And these are just our known costs, right? So the first is our principal and interest payment. That's what's going to go to the mortgage company of $764. Taxes at $100 a month. There's no HOA with this particular deal. Insurance, about approximately $54 a month. See, we've got our line item there for property management. So all in all, your monthly cost for operating this rental is $1,046. The projected rental income for this property is going to be $1,600. So this particular deal offers some really powerful cash flow at over $550 a month. So you see how cash flow can become so important to us as we're looking to replace income and become job optional. We might want to get 10 or so of these to have a good $5,000 a month coming in to offset those living expenses and give us those options. So that's the breakdown on cash flow. Now, what you do want to consider about cash flow, is there are some variable costs. Of course, you're going to have maintenance, you're going to have vacancy with any rental property, 100% guaranteed you will. So you need to plan for them. And there's a couple different ways that people do plan for maintenance and vacancy. Some people, they factor them in on their pro formas, and they'll add a line item here for a typical or an average maintenance or vacancy cost. And you'll see if you read the fine print on our pro formas, they're typically calculated between 3 and 6% of the rental income. What I usually do is just kind of have a general line item of 10% of the rental cost. So the rental income here is $1,600. So I might add a line item here of $160 a month, just accounting for that maintenance and vacancy overage. But of course, if you're buying a home that's newer or a home that's much older, you might want to adjust how much you save to plan for that. All right, so this is an example of cash flow. One thing I do want to point out, the second column here is if you are purchasing this property outright in cash, and you will see that your cash flow goes up substantially when you own a property outright because you've eliminated that principal and interest payment. So if I was someone who was really primarily concerned with hitting a specific number, and I was maybe less concerned about equity growth in scaling a portfolio, I might choose to purchase a property outright initially instead of using leverage. But you'll see, we'll talk about some of the other ways real estate pays you. I personally love leverage. Okay, some things that you want to keep in mind when it comes to cash flow. First, you should know that cash flow will likely increase over time as rent values continue to go up. This is particularly true in high growth markets where there is job growth, where there is population growth. There will be as demand outweighs the supply of rental properties, rent prices will of course go up. Just with general inflation, rent prices should go up. So over time, the longer that you hold an asset, the higher that cash flow projection should become. You will have some of your expenses go up as well. As property values go up, your taxes will likely go up. Of course, your management costs are going to go up as you raise your rent too, so keep that in mind. But you should definitely be thinking more long term about your cash flow, and don't get hyper focused on year one projections, knowing that over time it will likely grow. You should know also that it can be very hard to create cash flow in high cost markets. Many of our members are from the West Coast or the Northeast, and you have experienced this firsthand. As property values go up, the rent to value ratio gets compressed. It starts to suffer. As property values go up, rent prices also go up, but it's not in lockstep. These are delineating curves. At some point, rent prices find their ceiling. So if you're really concerned with cash flow and you want to go into a high cost market, you might have to reduce your leverage in order to create positive cash flow, meaning you put larger down payments down. At RealWealth, we really, in our market selection process, we really want to find markets where we can come in as maximum leveraged buyers, meaning 20% down payments, and there be some positive cash flow. But you will likely see, and if you've been a member of RealWealth for some time, or you've been analyzing property for some time, you have seen that there's definitely some variations. Some markets have a little bit more lucrative cash flow, and then some have a little bit less cash flow. Things you want to consider: there is usually a risk correlation with super high cash flow properties. Not always, but generally there is this correlation. As an investor myself, when I'm looking at pro formas, if I see a cash on cash projection, so let's say, well, here, let me back up real quick, and a cash on cash projection, this is what I always calculate when kind of looking at the relative rate of return. $500 sounds nice, right? But really it depends on how much money do I have down generating that $500. That's a more powerful metric. So that's called a cash on cash return. And you calculate cash on cash return by taking your total annual cash flow, $6,648, divided by how much cash you have invested. So that's telling you my money, for every dollar I have invested in this deal, it's giving me how many pennies, how many cents. And so for a deal like this is really aggressive cash on cash return, definitely double digit. As an investor who's been looking at deals for some time, this is usually an indication for me of a couple things. One, I probably am taking some more risks with this property. It's probably pretty likely that this is in a B class area, maybe even a C plus area. It might be more predominantly renters in this particular area. So that leads me kind of to my next point, and that is that cash flow is often inversely related to appreciation. So when I'm in a market that has really high cash on cash returns, it's usually because it has more moderate appreciation potential. The opposite also being true. If I'm going into an A-class neighborhood and it's a brand new house, the cash flow is going to be less because I'm taking less risk, right? I'm okay with a smaller return there because it's easier for me to manage those monthly costs. And then the next thing, if I'm getting a lot less cash flow, it's probably because I'm in a higher growth market. So I would probably generally expect to see a little bit greater appreciation. So these are just general rules, things to keep in mind as you are considering cash flow. Okay, so the second way to make money in real estate is principal pay down. This is, I think, something I am just becoming more and more concerned with as I'm growing a portfolio. It's the ability to use OPM, other people's money. Everybody's heard people mention that in real estate, but they don't always draw the correlation that's what, getting a loan, getting a mortgage on a property is. You're able to use the bank's money. I can come in with 20% down. The lender, the bank will finance the rest. And then as an investor, I can rent that property out to my tenant and have the tenant pay off the rest of that loan over the term of the loan. Of course, I have to have the cash reserves to float those payments in the event that a tenant moves out or that a tenant runs into hard times and stops paying. But so long as I'm working with good property managers, that tenant's going to go in there and pay down that loan for me. I've heard a great statistic before, and I love to envision this when I think about my portfolio. The statistic was that on average, individuals were spending about 25% of their income on housing. And I've heard more recent studies that say millennials actually spend closer to 50% of their incomes on housing. So what I love to envision is that for every door that I own, there's somebody, a tenant, getting up and going to work every day to send somewhere between 25 to 50% of their income to me and to paying down my loan and then the cash flow that comes to me. So I love that, again, I own 5 houses. That's the earning power of potentially a whole nother individual working a whole nother job for me. So it's really, really powerful to have your tenant paying down that loan for you. So what you need to keep in mind is that principal pay down can be slow at first. The mortgage companies, mortgage banks, they know on average how long people are usually staying in a home. And I think the average is about 7 years. People own a property, have a mortgage for 7 years, and they sell it. So very rarely is somebody holding a property for the full 30-year term. And so in order for it to be worth the bank's buck for giving you that loan, they want to front load the interest so that it's amortized to their benefit, right? That they can get the interest, as much of that interest as possible in that first 7 years while you hold it. So when you look at your principal pay down statements at the end of each year, initially that money that's accruing is a little bit less impressive. But the longer that you own that property, the more substantial those principal pay down becomes. And that's one of the best cases I've heard people make when they talk about, when do you keep a property versus when do you sell it? You don't necessarily want to sell a property right when you get into that more lucrative and efficient principal pay down phase. You might be thinking, well, I'm not getting as much cash flow. I could go and put it over here where I'm getting better cash flow. But you got to keep in mind that you're going to be starting over on year one for a principal pay down schedule. So it does become significantly more lucrative over time. And I do want to point out right now, interest rates are at all-time lows. There's lots of talk over the last 2 months about interest rates going up to a whopping 4% or 4.5%. And I've got to remind myself, when I first started getting really serious about scaling my portfolio, I was thrilled to death to be getting a 5% or 5.5% interest rate. Now homes are a little bit more expensive now than they were, so arguably that's not a really fair comparison, but still a 4% interest rate is extremely affordable money. And what you've got to consider is when you have lower interest rates, when you can secure loans with lower interest rates, that translates to more efficient principal pay down for you. So the rent for a particular property might be the same now as it was last year, but if you could get a loan at a whole percentage point lower, if you can get a 3.5 instead of a 4%, those payments each month that tenant makes, a larger portion of it is going towards the principal. That's money that you will get back. So I said it early on in the post-COVID era. I think that we'll look back at this time and in hindsight, kind of reflecting on what was the opportunity for us. And I think I'm pretty certain it's going to be the interest rates for investors borrowing that really, really cheap money. So the third way to make money in real estate is it's a hedge against inflation. It's amazing to me that banks are willing to give you a 30-year loan at a fixed rate. Meanwhile, the value of the dollar is decreasing. This is so applicable right now. I put this stat here at the bottom. In 2021, the estimated rate of inflation is over 5%. I think it's closer to 5.5%. The Fed has stated it has a goal of, in a normal year, of maintaining a 2% annual inflation. So they want inflation. It's amazing to me that in this year, if you secured some good mortgage loans at 3%, 3.5%, even 4%, just borrowing the money alone, you captured the spread here of inflation. Banks are willing to give you 30-year money, and they're never going to come and adjust how much you owe. So this is what I want you to think about inflation. Inflation works for us in two directions when we own rental property, if the property's levered. We're going to talk lastly about, appreciation. So inflation is part of appreciation, right? Property values are being inflated. It's requiring more of those dollars to buy the same asset as those dollars become less and less meaningful by themselves. So it works for us in a positive direction in that it's inflating the price of the home, the value of the asset, but it's also working for us on the debt. Today's dollar that we give the bank 30 years from now, it's not going to be worth $1. So the debt that we have on this property is eroding with inflation. Meanwhile, the value of the asset itself is appreciating, being inflated with inflation. So I think this is a critical piece of the wealth building strategy. You've got to hedge yourself against that inflation, and owning hard assets is the best way to hedge yourself against inflation. So this is a quick little graphic for you guys to show you the median home price. The bottom line here in blue is the median home price dating back to 1953. And then the orange line here is showing you that price adjusted for inflation. So this is in today's dollars, how much you would need to buy that same house. So it's pretty substantial what inflation does, and particularly over a 30-year period. In fact, I singled out a specific date range of a 30-year mortgage for you. This home, if we assumed nothing else had changed about this property, which clearly from the pictures we can tell there was some forced equity in this scenario as well. Somebody rehabbed this home and it's likely more desirable. So there's probably some additional value here besides just inflation. But let's take all of that away and just look truly at inflationary dollars. This home in 1990 cost $97,000 to buy, and adjusted for inflation, it would be $195,000. So the power of inflation over time. All right, the fourth way that real estate pays you is in the tax benefits. So again, I have to restate here, I am not a CPA. I hire a CPA for myself to handle all of my taxes. I've said before that, you know, I could probably pull my own tooth too, but I hire a dentist for that as well. I could do it myself and save some money. I'd probably endure a little bit more pain and I might not do it right, but I could probably do it. And I feel the same exact way about taxes. I could probably figure it out myself. It'll definitely be more painful and I will likely be doing it wrong. So I strongly advise you to get your tax advice from a CPA, not me, but I do want to highlight some of the tax advantages of owning property. The first is deductions. You get to deduct potentially all of these items here, your interest on the loan. And that's interesting to me, considering that, again, your tenant is paying down that interest, and yet you get to deduct it on your taxes. The property taxes you pay on it, the insurance you pay, maintenance expenses, repairs that you do, capital improvements, even professional fees. So if you have licensure, education, if you're attending conferences and books, if you're traveling to go visit property, if you're traveling to go attend education seminars, it is very likely that you have some deductions that you can take on your investments. So definitely talk with your CPA about that. They do add up. And then I put this little asterisk here at the bottom. It could be a whole class all on its own, but I want to be sure that you need to talk to your CPA about the potential of becoming a real estate professional. Now, this is a different designation. It does not require that you be a realtor and have a licensure. It is truly a tax definition. There are some very specific criteria that must be met. There's a specific hour requirement. I think it's 750 hours a year you have to spend, and you cannot have another job that you spend more than that amount of time on. But when you become a real estate professional, it's essentially a way to, your deductions right now, these are on passive income. So when you become a real estate professional, it can be considered active income. And so there you have the potential to carry over deductions to cover over active income. So this is a really, really powerful tool that you want to be sure that you talk to your CPA about and find out if it's something that you or your spouse potentially could qualify as to boost those tax benefits that you've got. Depreciation is another huge tax benefit. So this is kind of ironic. We just talked about how we know that over time property values are going up, But what's interesting is that the IRS says that homes are worth less over time. In fact, they have said that the lifespan of a home is 27 and a half years. So what they let you do is they let you take the value of the home minus the land. So you're just looking at the hard asset, the home itself, and you get to divide it by 27 and a half years, and you get to deduct that dollar amount every year on your taxes. So this is how, on paper, your property can have positively cash flowed and giving you thousands of dollars over income. But from the perspective of the IRS, it's actually a loss because the home was depreciated over that time. So that's a really powerful tool as well. And then another tax benefit for owning real estate. Again, this could be a class all on its own. In fact, we have hosted classes with 1031 exchange facilitators on this topic, so I don't want to go too in depth. But what you should know is that a 1031 exchange, also called a like-kind exchange, is a tax deferment strategy. Essentially, it says, normally when you sell an investment property, if you sell it for a profit, if you have a gain, you're going to pay a capital gain tax on the profit, on the money that you made on the sale of that home. However, to incentivize home ownership and to incentivize, people investing their money back into an economy where rentals are needed, they have developed this like-kind exchange, which essentially says you can sell that property, and instead of paying the capital gains tax, if you reinvest that money that was in that property back into new rental property, you can defer the capital gain tax. You don't have to pay the tax. You get to kick the can down the road. Now, real quick, just something important to know about a 1031 exchange. You have to replace the total value of the relinquished property. So if you sold the home for $300,000, to accomplish a 1031 exchange and to defer all of the capital gains tax, you would have to replace it with at least $300,000 of new properties. And it could be multiples. So this is an incredibly powerful wealth building strategy, so much so that it seems to just repeatedly come onto the docket in Congress. There's people who want to get rid of this tax loophole, as they call it, because it is a way for people to pass along substantial amounts of generational wealth. In theory, you could do a 1031 exchange indefinitely. You could 1031 exchange and turn 1 into 2, 1031 exchange those 2 and turn into 4, et cetera, et cetera, et cetera, all the way until you pass away, until you die. And then your heirs will inherit those properties, and the taxes will step up in basis for the heirs of that property. So it's a huge way to transfer very large amounts of generational wealth without paying the capital gain tax, and it's totally legal. So this is definitely something, if you're not familiar with, don't put too much pressure on yourself if you're just getting into real estate to studying this, because it is a secondary is a secondary strategy. You've got to get some of your first rental properties first before this even becomes applicable, but you should definitely know that it's there, and it's a really powerful wealth building strategy. All right, and the fifth and final way that real estate pays you, it's the cherry on top. We put it last on purpose because it is not in and of itself, I think, a good reason to invest in real estate. A lot of people have experienced appreciation in their primary homes, especially those of you Californians who had just amazing timing. And when you bought your primary, there's likely many of you on the call today who have experienced incredible appreciation in your primary. So naturally, you're going to be really inclined to look at all deals through this lens of appreciation. But for us, it's the cherry on top. Home values, we know, have historically gone up. I'm going to show you a graphic here on the next slide that shows you over time home values. They're going up. It's very likely the home you buy will appreciate if you hang on to it long enough. However, it's subject to market cycles. So there might be little ups and downs along the way, but the trend line is up. Now, what you have to understand about appreciation is that your gains, the appreciation is unrealized. It's hypothetical until you sell it, or until you tap into that equity through a HELOC or maybe through a cash out refinance. So to get really obsessed with the appreciation in your home is to get really obsessed with checking the value of your stock or your mutual fund, right? It's nice, it feels good to see that that number has gone up, but it's not yours until you sell it, right? Same thing with the appreciation in your primary or in a rental property. It's an unrealized return. To give you a little bit of expectation on what is typical appreciation, we generally refer to our markets, they're either one of two market types. They're either a linear market or they're a growth market. Linear is in reference to the property value. It's flatter. Historically, linear markets, they're not appreciating at a very fast rate. They're usually keeping current with inflation, but there's no other outside economics that are forcing property values up. So, population isn't growing as fast, therefore the housing supply can keep up or is steady. And so there's no real appreciation beyond just the rate of inflation. And then you have growth markets. Growth markets are defined as markets where there's a little bit more appreciation potential. This is where there is more job growth, there is more population growth, and so it's forcing home values up. So a general expectation is it should beat inflation. It should be between 3 and 6%. Now, I started to update these percentages this year because there was not a single market that had 0% appreciation probably over the last year. But we do not want to compare last year. We don't want to look at last year and use that as a long-term expectation for growth. It's just completely unrealistic. So I decided not to update these. This is typical, but you should know that over the last year, even the linear market saw substantial appreciation that outweighed the rate of inflation. The thing you have to know is appreciation is always speculative. No one knows with certainty what is going to happen to property values. So you've got to treat it like it is speculative. That's why we never go and chase negative cash flowing assets for the hope of appreciation. We still want to pay attention to the fundamentals. We're still looking for sustainability. Even in markets where we think appreciation is pretty dang likely, we don't count on it. So here's that trend line I mentioned. This is a look at the average sales price of homes in the United States dating back to 1965. So what I love about this graph is that it depicts periods of recession. So these gray bars that you see here are times of economic recession. So you can still kind of see what did home prices do during those periods of time. And you can see, obviously, the longer you hold the property, the less you're really impacted by these. What would stink is if you bought a home up here on the rise and then you're forced to sell on the dip. Again, that's why that sustainability is so important for us, because if the property you purchased is fundamental, if you have a fixed rate mortgage, if there's positive cash flow and home values come down, there's no reason that you have to sell. You just hang on and let property values recoup. The interesting thing is that during this time of recession, when home values plummeted, the people who lost their homes, they didn't disappear. They still had to live somewhere and they became renters. And so it was often the case, at least in the markets where we were investing, that rent prices actually went up during the last recession. So for people who were in very solid fixed rate loans, they could hang on to those properties and get them through to the next upturn. And of course, now property values are higher than ever. So again, this trend line gives us confidence that we know over time home values are going up, but it shouldn't give us false confidence that we should speculate and buy on the gamble that they'll continue to be up or that they will be up in the exact moment that we might want to sell. All right, I already mentioned this one, but I had to put this graphic on here that I saw from CoreLogic today. Appreciation can be extremely volatile. I mentioned over the last year, 2020, 2021 being awful examples of what is predictable in the housing market when it comes to property values. In 2021, the national average appreciation was 18%. That's an average of 1.1% a month, which is insane. But look at what people are forecasting for 2022. That growth is going to slow down tremendously, which is, I think, probably pretty needed. It just got really overheated. And so it's not that property values will go down, but they won't continue to grow at that alarming rate that they did. One thing I want to be sure that you know when you're looking at, total return on investment. So when you're looking at, all of the different ways that real estate pays you and you're considering appreciation, you've got to realize that when you invest with leverage, when you buy with a loan, you only have 20% down. This boosts your appreciation returns. And so I did a little scenario for you. Let's say that in 2020, you bought a home for $200,000. And let's use CoreLogic's numbers and say that you experienced 18% appreciation on that property. So today in 2021, the value of that home would be $236,000, an 18% appreciation. So an inexperienced investor might go, okay, that was 18%, an 18% return, right? But they would be wrong if you were a leveraged buyer. If you were a leveraged buyer, you bought that $200,000 home with 20% down, only $40,000. So your return on investment is actually 90%. You've almost doubled your money in just 1 year. Again, let's acknowledge the year that was. This is not typical, a 90% return on investment in 1 year, but still, this is a great example of how leverage boosts that appreciation return. Don't just see a 1 or 2% return in a linear market for expected appreciation and think, meh, that's not that much. Consider the fact that if you only have to put 20% down, that could actually be a fantastic rate of return. Okay, so that's it. We've gone through all 5 ways. And what I hope that you take away from this presentation is I want you to see how anytime you're looking at any opportunity, you have to zoom out and you have to look at all 5 ways that real estate pays you for that specific property. Again, we talked about how there's some inverse relationships between return types here. And so I've put up some possible scenarios to kind of guide you through what my thought process is when I'm faced with this specific scenario. So let's first use the example of being a cash buyer. Let's say I want to purchase a home outright because to me that feels more financially responsible. Debt is dumb, right? And so I want to buy the house in cash. Well, let's look at how that would impact our return in each manner here. Well, cash flow, we know from that first example, if I own it outright, I don't have to pay the mortgage payment. So my cash flow is going to be higher. I will have a larger cash flow differential coming to me each month. Principal pay down becomes non-existent, right? There's no getting, my tenant isn't paying down a loan for me. There's no lender involved. So this revenue stream here goes away completely. The tax benefits are actually kind of reduced. You get to depreciate, remember, the interest that you pay on the property, and you no longer have that. The hedge against inflation. Now, the inflation will certainly help the property value just as it would if you owned it with leverage. But you don't get the hedge on the debt side of it. If you don't have a loan, you're not taking advantage of yesterday's dollars with that loan. So this benefit is definitely reduced. And then appreciation. Appreciation is unchanged. It's always going to be, a percentage of the value of the house. But as I just demonstrated on that last slide, the relativity of that appreciation is reduced because you have all of your money in that one house, right? Maybe you get 18% appreciation on that one house that you own outright, but you could have taken that same amount of money and spread it out on 5 homes, and you would have had 5 times the appreciation. So the appreciation potential from a portfolio perspective when you buy in cash is a lower rate of return. Okay, so what about the scenario where you have really high maintenance expenses? Let's say you have just a tenant issue and the tenant's either not or no, that's our next one. We'll save that one. So high maintenance. Let's say that you have some major capital expenditures. Let's say, I mean, I had this just the other year, you know, a weather incident occurred and a tree fell on part of the property and took out the power junction box and had to do some exterior repairs. It was costly, right? So I might have a really high maintenance year and I'm thinking, God, I had no cash flow. I was counting on this home to give me, you know, $4,000 this year and I'm negative cash flow. So certainly high maintenance years, they can completely cannibalize our cash flow. Principal pay down, fortunately, as long as that tenant was still in there paying rent, it's unchanged. That money is still accruing for me there in principal pay down. The tax benefits can actually get better. I might have more deductions that I can take because I've had more maintenance or more improvements to the property. Hedge against inflation is unchanged and appreciation is unchanged. So that's the scenario. When I have these really bad years where cash flow is really poor or negative, what my practice is at the end of every year, I sit down and I pull up my mortgage statement. How much principal did I have accrue? How much tax savings did this property offer me that year when I filed taxes? You know, I take a look at what was inflation for that year? How did that impact the debt that I owe on it? And how did it impact the property value? What is the value of the property today? And very rarely am I still upset when I zoom out there and look at all of the different ways that real estate paid me. Now, the next scenario, what if you have a non-paying tenant or you have a long period of vacancy? This can be extremely frustrating. I gotta tell you, nobody would be buying real estate if you couldn't get rent checks, right? That is the most critical piece to this. It's gotta be rented. So periods of vacancy or periods of a non-paying tenant are painful. And so your cash flow clearly goes away. Principal pay down, you made those payments for yourself. So that's just your own cash now that you've put in the principal pay down. So that's definitely less than it should be. Though the money is still there, I would add, it's just coming from one pocket to the other. Tax benefits, there might be some upside there. You might be able to make some more deductions. Hedge against inflation is the same, appreciation is the same. Something that came to mind with this particular scenario, I was talking with an investor the other day who bought in a linear market for cash flow. He bought a really high, really aggressively cash flowing property, and unfortunately, and this is in a market, again, that's linear, so he wasn't expecting appreciation. And unfortunately, he's had tenant problems and he's not getting rent checks. And it's upsetting. I'm with him. I've got one of those myself right now. And he's so down about the return on this property. And so I start kind of guiding him through, you know, thinking about it holistically and looking at all the different ways it pays him. And through our conversation, we realized this home over the last year that he bought for cash flow's been obsolete, but this home appreciated significantly and he wasn't expecting it to appreciate that much. And through my conversation with him, I started feeling less and less bad about his scenario because I'm realizing, well, whoa, this house appreciated incredibly. You know, no wonder you don't want to get rid of it because it's done very, very well for you. Yes, that's an unrealized return, but zooming out helped him to kind of see this still made sense. This still created wealth for you. Maybe it didn't help you get any closer to quitting your day job by replacing your income, but it certainly helped improve your net worth. Okay. And then the fourth one is a down market when it's time to sell. This kind of goes back to that graph that I showed you. You know, if circumstances obligate you to sell during a specific time and you don't have the choice of timing your exit to capture the most appreciation, this is where if you've bought a fundamental property that made you money all along, you don't have to be hyper focused on the fact that technically you're selling it for a loss because you achieved principal pay down. You had substantial cash flow the whole time you had it. You hedged yourself against inflation. So selling it for, you know, a little bit of a loss might not actually be a loss when you consider the return over time. So just keep that in mind. A thought just came to me that I want to share with you. with regard to the principal pay down, because it's very similar in my mind to the appreciation. It's kind of an unrealized return, right? And somebody asked me a question the other day that I thought was a good question. They said, what should I be doing with the cash flow? Should I apply it towards the principal? Should I try to pay down the property quicker? And my initial thought was, no, don't do that, because it traps your money. It puts it in this piggy bank that in order to access, you have to pay somebody else to get it, right? So you're putting your money, you're locking it up into that mortgage. I think that that's something I would probably suggest you avoid unless you are in the process of, really wanting to create efficiencies in your portfolio and you want fewer doors. You're less concerned with the total rate of return and more concerned with efficiency and boosting that cash flow return as you coast into retirement. Then I could definitely see paying down, the principal on a note. I still might choose to keep the money that I would pay towards the principal in maybe really low risk mutual fund or something so that it can earn a return, and not throw it straight to the principal until I have enough to pay it off outright, right? Because it doesn't change anything about the return of that property to just put, a couple $1,000 at a time towards that house. It changed nothing except, again, it locked up that money where now I don't even have the option to use it if another deal came my way. So I still might choose to kind of, stockpile the money in a really safely invested account so that it's not eroding with inflation, and then make the decision once I have enough money there to pay it off all in one swoop. To boost the cash flow yield. I might choose to do that instead. All right, that was a little nugget that just came to you right off the top of my head. I hope that made sense. All right, so hopefully that has you really excited about the prospects of owning real estate, of owning rental property. And this is what we are all about at RealWealth. We really are passionate about streamlining the investing process, making it easier for the everyday average person to understand. And then secondly, to have a tactical means by which you can acquire property. And that's where the network piece comes in, and I'll explain that in just a second. But these are our co-founders, Rich and Kathy Fecky. They are wonderful examples of people who are living real wealth. And we don't define wealth as having a bunch of money. We define wealth as having the time and the freedom to live life on your own terms and to have choices, to have autonomy over your schedule, over your day. And Rich and Kathy and all of us here at RealWealth are big believers that real estate is the best way to do that. So how we help our members, just like we did today, we educate for free. We provide a ton of education resources. We have a whole library of classes ranging from very entry-level beginner concepts to more tactical, more strategic, high-level classes. And they're all accessible on our website, realwealth.com. You can see all of our free education resources there. The second part, when you become a member of RealWealth, when you join, when you create an account, it's free to do so. You get access to our industry connections. So I mentioned we're not just passionate about teaching you how to do it, but we want to give you vehicles. We want to give you ways to actually act on the information that we've provided you. So we have a whole team internally that's dedicated to vetting and screening resource partners, lenders, 1031 exchange facilitators, CPAs, attorneys, as well as what we call property teams. These are real estate investing firms in specific markets that specialize in finding distressed property and rehabbing it, or building new construction property specifically for investors. So we connect you with these vetted teams that we have across the country. And as I mentioned, we're in about 12 different markets. You also get access to an experienced investment counselor like myself. There's actually 4 of us. Me, Ben, Joe, and Aristotle. We are all investors. We are all buying through the teams at RealWealth and outside of the teams at RealWealth. So you get access to us to talk about strategy, to talk about pros and cons. Again, I'll never tell you the way to do anything, but I'm happy to engage with you in a dialogue of exploration to help you find what might be the best strategy for you. So when you become a member of RealWealth, you're automatically assigned an investment counselor, and you've got access to us through the process. And then the biggest benefit of Real Wealth is that you're part of the combined power of a collective. We are a group of real estate investors. And so we see trends, we see opportunities, we see pitfalls sooner than you might if you were on your own. And then we also have leverage, right? When we represent a very large group of real estate investors, when we go into these markets, we can command a little bit of preference, especially in a market like today where it's so hard to get deals. The leverage that we have when we go to builders or when we go to rehabbers, the fact that we have institutional level volume through our collective, that says something, and you get to be a part of that at no cost to you. I want to mention here because I feel like this would be the next question that would come to my mind if I was watching this for the first time. Okay, this is too good to be true. Where's the catch? We've all got our scam radars up, right? So how can you guys do all this for free? That can't possibly be true. So I want to be totally transparent about how Real Wealth makes money. We are a referral network. We're an education company and a referral network. So we monetize our business through broker to broker referral fees. So when you purchase a property from one of the teams that we refer you to, if you buy from them, they pay us that broker to broker referral fee from the proceeds of the sale. So it doesn't cost you anything to benefit from all of these resources, and we don't make any money unless you buy. So I love that about the structure of this because it incentivizes us to make sure that we're providing you with the best industry connections. Because if you don't buy, we're just doing a little hobby over here. Okay, so what's next? So if you're watching this webinar live, you are already a member of Real Wealth, so definitely start to leverage the additional benefits that you have. But if you're watching this on replay or you're watching this on our YouTube channel, you can become a member of Real Wealth at realwealth.com. It's free to do so, and then you can begin the process of educating yourself. Tons of webinar content. We've got market pages for all of the different markets where we're in, where we have significant amounts of webinar content with people who are in that local area, property managers in that area. We look at deals together. We analyze pro formas. So there's just tons of education resources for you. Again, you've got access to your investment counselor, so feel free to schedule a free strategy session call. You can do that directly from the website. I tell everybody your first step, if you're serious about this, if you're serious about getting into rental property, is to learn about your purchasing power. Get yourself pre-approved with a lender, and not just any lender, a knowledgeable lender who specializes in investment loans. And we've got a list of those lenders on our resource page as well. And then you can begin to leverage the Real Wealth network of property teams. So as I mentioned, we've got about 12 different market pages there where you can start to connect with those relationships. You start to develop your own relationship with them. They'll get you connected with their real-time inventory. They can schedule a visit out to the market, take you around to see property or get familiar with the area. I always point out the fact these people who we work with, they are real estate investors too. So you're getting the opportunity to go and learn from people who have been investing in this market that interests you for a long period of time. And you get to benefit from their years of lessons learned. And then hopefully that leads to you identifying a property and getting in on the game, getting in on these 5 ways that real estate can pay you. All right, so that is it for the scheduled programming here. Let's get to some questions. I'm going to pop open my questions panel here. If you've got any burning questions here, send them in, and I'll try to get through most of these. Okay. Someone asks, I have been a real estate investor for the last 3 to 4 years. Why do investors prefer 30-year fixed rate loans versus 10-1 ARMs, adjustable rate mortgages, for example, since in most cases, the investment property will be sold or exchanged within the next 10 years? That's one of those questions that there's no right answer to. I mean, I think it totally comes down to risk tolerance, right? A lot of people love the 30-year fixed rate because it frees them up from a time schedule. They can look at the fundamental math today and go, hey, this property doesn't have to it doesn't have to appreciate at all, and these numbers work. This math works. But if you're if your investment is time bound and you are obligated to either pay a higher interest rate or sell it or refinance the property, this is where things can get really tricky. But to your point, you're right. Most people aren't holding the property for more than 10 years. So if you feel pretty confident that you won't be holding it for more than 10 years, I say consider the adjustable rate mortgage. It's certainly a possibility. Oh, Rory points out prepaying the principal on a loan changes the amortization schedule, which does result in less interest paid over the remaining life of the loan. Good point, Rory. All right, Shrikant wants to know, do we suggest incorporating before buying rental properties? No, not necessarily. There's a lot of emphasis put on entity formation, and sometimes I think it's a little bit premature for some people. They get so hyper focused on entity formation that becomes that seems to become the goal rather than acquiring property. A lot of investors get their start by acquiring property in their individual name. In fact, if you're looking to leverage the conventional loan, that is a loan for individuals, so it cannot be given to an entity. So what you might end up doing anyway is financing the property in your individual name to get a conventional loan, and then after the fact, moving it into an entity structure. But it's certainly not a requirement. In fact, I would encourage you, educate on asset protection and entity formation, but don't let it become a ball and chain to your progress, because it quickly can become that if you let it. Wow, you guys are going easy on me. Those are really all the questions? All right, I think that's it. Yeah, there's another person here saying that they like to pay down their mortgages with the cash flow, getting a return on it equal to the rate on my loan. It just means that I'm reducing the loan duration. Certainly, good to hear that perspective. Dennis says, is high cash flow and appreciation opposite ends of the spectrum, or can I find a property with both? Well, Dennis, that's what we're all looking for, right? Ideally, we'd all like to have the highest cash flow and the highest appreciation, but the reality is it's a little bit of an anomaly, and you certainly wouldn't know in advance that it was going to be both, probably. The scenario I hear more often is that it's luck. One of those will become luck. I bought a property this past year. It was going to be my growth play in a growth market. The cash flow was very thin, not knowing that the boom of 2020 and 21 would mean that cash flow, that the rent prices would go up tremendously. So by luck, this house is a high cash flow and high appreciation property, but it's certainly not something I could have forecasted on my initial underwriting of that property. So I think what's most important, Dennis, is that you understand the correlation, right? Understand the expectation. Generally, they are inversely related. If you're looking for high cash flow, it's probably at the cost of appreciation. If you want the best of both worlds, I think you should think about moderate returns for both. You know, what is considered to be a moderate rate of return for cash on cash? What is a moderate rate of return for appreciation? For me, the line in the sand kind of my expectation when I was investing in a linear market, I usually wanted to see double-digit cash on cash return, but then I understood that that usually certainly meant single-digit appreciation, but probably closer to inflation. You know, so it was just adjusting my expectations depending on where it fell on that meter. When investing in a rental property, is it better to invest in a market with a high percentage of renters or a low percentage of renters, or does it matter? This is a good question. And I think it depends, right? Generally, you will see better appreciation in neighborhoods or areas that have fewer renters. Owner occupant properties just tend to hold their value a little bit better, and they tend to appreciate a little bit quicker. So you will definitely see that inverse scenario. You'll see a little bit less cash flow generally in a predominantly owner occupied neighborhood. When you're looking in a neighborhood that's really heavily concentrated renters, that can often mean that property values are a little more stagnant because the people who are buying there are investors. And we all know how cheap investors are, right? I'm one of them, so I can say this, but they want the best deal. They're not getting emotional about a property. It's all about what does the property earn. So it really just depends on what your objective for that return is. I think there's pros and cons to both. That's why in my intro I mentioned that I invest some of my portfolio. I diversify some of my portfolios for more cash flow. Some of it is for more appreciation. And when I want more appreciation, I'm trying to get into those owner-occupied neighborhoods. Properties are few. What linear markets have properties? Gary, that's the elephant in the room, isn't it? Yeah, there's just a lot more competition for properties today. Inventory is low, especially in the linear markets. Um, we still have teams that are having deals, but what I will tell you, I've used the analogy of hungry hippos. It feels like we're playing a game of hungry hippos. 3 or 4 marbles fall out on the table and we're all chomping at the same opportunities. So what I would tell you is preparedness is so important in these linear markets. All of our linear teams that you see, so this is the Midwest, this is Alabama, this is Baltimore, Maryland. In the Midwest, I'll be more specific: Indianapolis, Cincinnati, Chicago. These areas, the teams are all having deals, but they're having 3 or 4 deals at a time, and they are oftentimes getting contracted before they even have to market the properties. So all the investors that I speak to, I tell them the key to getting inventory today is proximity to the team. You definitely have to be engaging them. Don't think that you can sit back on your heels today and have deals fall into your lap. It's not happening today. But they're there. I'm seeing closings in those markets every single month. Do you strongly suggest visiting the properties at remote locations before buying? Shrikant, this is totally an individual preference. Personally, I don't think it's a absolute. I haven't seen the majority of the rental properties that I own in person. Though I would say before the times of COVID, I would say probably 50% of our RealWealth investors were traveling to a market before buying there. And it wasn't so much that they could go and look at a specific property. It was more so that they could do kind of a reconnaissance mission of the area, right? Get familiar with the neighborhoods, go meet the property managers, walk through some properties that were under renovation or under construction so that you could get a general sense of the quality of work and the general neighborhoods that they were investing in. That way you're emboldened when you're back home and you get an inventory list and you see a property in a specific area. You remember it. You know exactly what that area felt like, or maybe you've discovered that you have a specific preference. So, if you can travel to a market, you feel comfortable traveling, I recommend it. I have had several experiences where seeing something, worked in my favor, and I was able to pivot or adjust my approach based on what I saw. But I also have some circumstances where I know if I had seen a property before I bought it, I probably would have chickened out. And that property has turned out to be a great investment for me. So keep that in mind too. Your personal biases, they can be hard to keep reined in appropriately when you go to some of these areas, but it's certainly not a requirement. I would say today probably maybe only 10 to 15% of people are traveling to a market before they buy there, just because not everybody's as comfortable with traveling yet. All right. How does RealWealth look at short-term rental properties like Airbnb and Vrbo? Oh, Stephanie, this is such a hot topic right now in buy and hold real estate. There are so many people entering this space of vacation rentals. We like the idea. It's a new concept to us, so we don't want to be, I think, too vocal about, this is the strategy, this is what works, until we've really had the chance to experience it in real time. We've got a couple investors internally who are starting to invest in vacation rentals. I'm really curious about it and have been researching it, but I recognize I've got a lot to learn before I commit. We do have a couple teams in Florida who are experienced with vacation rental property. And they have been doing it on their own, and they are helping some of our members find vacation rental property. So if it's something that interests you, Stephanie, reach out to your investment counselor. Let's have an initial conversation about it, and then we can refer you to the specific teams that we feel comfortable, with their operation thus far. but we'd like to scale in this area. I mean, I think there's great opportunity there. There's definitely some different risks there. If you haven't seen, we did a webinar right before Halloween, actually. Joe and Ben, two other investment counselors, they recorded it. It was in keeping with our Halloween theme, it was the horror stories of vacation rentals. And they actually talked quite a bit about due diligence and how to help you avoid pitfalls with vacation rentals. So check out that replay. If you're logged into the investor portal, you'll see it under recent webinars. All right, let's see if there's any more here. Is an exit selling the property at some point a must before buying a property? No, I don't think so. Um, only because things change so much. I think it's kind of impossible. I mean, certainly you should have an idea about what the different exit strategies might be, right? In a growth market, maybe you're thinking, okay, this is a shorter term hold. Ideally, I'd like to hold this maybe for a 5-year period and then exit and take the equity growth and spread it out in a different market. But again, that if your strategy involves a speculative return, then it might not pan out that way. So that's again why be comfortable with options of an exit strategy. But no, I mean, I have some properties that I bought thinking they were going to be high cash flow and that they were going to be homes I just hold forever. And then years down the road, they've appreciated way more than I thought they would. And they're high touch properties. They're just needy. And so I'm like, this is time to sell. Like, I was planning on keeping this forever, but it's way more touchy than I'd prefer, and it's appreciated really, really well. So I'm going to tap out early and sell it before I had planned. So certainly let your strategy be a little bit flexible to what the market is offering you, and let it respond to your real-time experiences. I mean, and frankly, there's some markets that I'm in where it's just, over time, I just am not that excited about it compared to others, So my strategy has certainly evolved, and I think probably many investors would agree that they've let it intentionally be a little bit open-ended. As an investor, what should one do when in certain markets there's so much bidding going on? Yeah, the bidding wars are tough. I mean, this is where I think it's you really want to still pay careful attention to the fundamentals. Bidding wars can result in an emotional response, and you could find yourself going beyond where you maybe should have for that deal to stay fundamental. This is why I think it's really good to work with RealWealth property teams, because they operate in a strict first come, first serve basis. We have one team that's an exception, and they're acting more as a buyer's agent, helping you submit offers on properties that are on the open market, and the bidding war thing is real. And so our advice is, if you don't have the stomach for that or the bank account for that, work with one of our teams where the prices are fixed, and be in there and be the first one to contract it. It's all about who you know right now. I really think you've got to have some connections that can help you kind of jump the line a little bit. Does the team also consider crime rates of an area, which can result in more defaults? Yes, absolutely. We're not desperate for that cash flow. You can go and chase really high cash flow yields in super high crime, dangerous areas, D-class neighborhoods. Looks good on paper, but what the reality will be is that you're unlikely to collect rent, and it's going to be one of those high touch properties. So absolutely, our team is very familiar with what is the kind of best of both worlds buy box in that market. Where's the bridge too far, where that risk factor goes up so tremendously, and where is the just right house, where I'm taking risk but it's offset adequately by the return. So yeah, absolutely, they're considering the crime rates of the area. I will caveat it and say that you are in the driver's seat of your own due diligence, so you definitely want to do some research on crime rates. We recommend that you look at websites like niche.com, Niche. I love citydata.com. They have a lot of information about crime rates. Throw in your own address in some of those places as well, so that you can get some feel for relativity, because I've read some horrifying crime rate overview statistics, and then I've put in areas that I know, and I've equally found horrifying crime rate statistics that shocked me, that surprised me, right? So just because it says something there, that doesn't necessarily indicate the feel of it in a specific street or specific area. So there is some nuance there. Okay, Leah, how many doors are you up to now, and what percentage is cash flow versus appreciation? I'm getting up there, Brenda. I love this stuff. I'm a bit of an addict now. Still working on my Fannie Freddie loans, but definitely trying to wear those out as soon as possible. I would say right now my focus has been more primarily on appreciation markets. When I first started really getting serious about scaling my portfolio, I focused on high cash on cash return because again, the goal was like cash flow, quit your job, let's spread this capital out. I want the highest cash on cash returns as possible. And I love that I did that because it did allow us to create scale very fastly in a portfolio, and portfolios insulate you from risk, right? When you have more doors, you have more insulation from the volatility. Just like a mutual fund, right? If I go buy one stock, I'm directly tied to that success or failure. If I invest in a mutual fund quickly, I'm insulated. I don't feel those bumps as much. So I'm grateful that I did that. But now I'm kind of seeing that for me, not well, unfortunately, I found myself in a job now that I like. So I'm not as concerned with quitting my job now, but I'm focused more now on these appreciating markets where there's a good hybrid return because I feel like my net worth grows faster in that way. I found that, the maintenance and vacancy costs in a growth market and a linear market were a lot of times pretty close. If I had one tenant turnover in a growth or a linear market and that, it took me a week or two to get it put back together and rented back out, that was oftentimes enough to cannibalize the cash flow. So then when I would go back and look at all the ways that real estate paid me, I was finding that, you know what, I wasn't getting really great principal pay down because those loans were dinky little loans. I wasn't getting much appreciation. And even if I was, it's a really small value property, right? So 6% on a $100,000 house doesn't feel near as good as 6% on a $200,000 house, right? So I started just seeing, look, it's not about cash flow for me today. I need it for sustainability, but I'm going to pursue more balanced return. I'm going to go and pursue these markets where there is a greater growth potential because I just think that's a faster way to grow net worth overall. So that's where I'm at. I'm loving Florida right now. Really loving Texas. Just trying to get as many good fundamental bigger loans as possible. All right, the more I talk, the more questions come in. So I don't think this is ever going to get wrapped up, but let me find a good one here to end on. Okay, we'll end on this one. You mentioned that investors don't pay RealWealth Network fees, but that isn't true for all of your market partners. What percentage of your partners pass along the RWN commission charge to investors? Brandon, that is not true. We used to have a couple teams who charged an additional buyer's fee. They frankly weren't willing to cover all of RealWealth costs for you since you were the one that benefited from it, not them. And so they did charge an additional buyer's fee, but we came in with our leverage and we negotiated that away. So there is no longer any teams that charge you any additional fee to work with them as a RealWealth investor. Only ups for you. All right, guys, I am so appreciative of your time today. Thanks so much for sticking with us, and thanks so much for being a valued member of RealWealth. If you're watching this on replay, we'd love to have you come join us. Check out realwealth.com and become a member today. Y'all take care. Bye-bye.